Assalamu alaikum. Good afternoon. We welcome you all in our discussion meeting. Today, joining us is our CEO, Mr. Abdul Hakim Al-Ujaili, our Deputy CEO, Mr. Gopakumar, and our Chief Maysara Banking Officer, Mr. Kamal Al-Razza, and our Chief Financial Officer, Mr. Vikesh Mirani. For today's session, we will start with the half-year presentation as at 30th June 2022, followed by today's session. I will pass it now to our CEO, Mr. MSX for comments.
بسم الله الرحمن الرحيم. السلام عليكم ورحمة الله وبركاته. بالنيابة عن الإدارة التنفيذية لبنك ظفار، يسعدني الترحيب بكل من شاركنا هذا اللقاء لاستعراض نتائج البنك للنصف الأول من العام 2022، وأخص بالشكر بورصة مسقط على تنظيم هذه الفعالية، وذلك تعزيزا لمبدأ الشفافية بالسوق العماني. Good afternoon, ladies and gentlemen. On behalf of the executive management of Bank Dhofar, I would like to welcome you all on this session for presenting the financial result of the first half of the year 2022. In this regard, I would like to thank Muscat Security Exchange for opening this opportunity to meet with the investors and analysts, which is an important step towards encouraging transparency culture in the market. So welcome to all of you, and I will pass the mic to our colleague, Mr. Faisal Makki, to manage the meeting going forward.
Now I'll request Mr. Vikesh Mirani to start with the presentation.
Thank you, Faisal, and thank you, Mr. Abdul Hakim. I do echo Mr. Abdul Hakim's comment, and good afternoon to you all, and welcome. I'll welcome you all for our first half results session. We have a presentation that we'll be taking you through, so I'm hoping you are able to see our screens. I will immediately take you to slide number 4, which gives a brief snapshot of Bank Dhofar and its performance during the first half of 2022. We are the second largest listed bank in Oman in terms of total assets, which stood at 4.38 billion as at the end of the second quarter 2022. Our market share in Oman in terms of assets and loans stood at 13%. And deposits at 12%. We have a diversified offering of various products which we do through our retail, corporate, Islamic, and treasury businesses to our customers. We do enjoy a robust, strong capital position with our total capital adequacy ratio at 17.15% as at the end of the first half of 2022. We are rated by two rating agencies, which is Moody's and Fitch, with Moody's assigning Ba3 with a stable outlook and Fitch at BB- with a stable outlook. The table that you see on the right-hand side of the slide shows the financial highlights over the last 4.5 years, including the first half of 2022. The total assets, as I just mentioned, stood at 4.376 billion. Our total equity reached 701 million Omani Riyal. Our net loans and advances and financing to customers stood at 3.321 billion Riyal. Our customer deposits stood at 2.953 billion Riyal. Our total operating income stood at 70 million. It was largely flattish over the last 4 years as we came out of the pandemic, and it started now improving to 70 million in the first 6 months of the year. Our net profit in the same period stood at 16.4 million OMR. Next slide shows the ownership structure and asset composition of a bank. We have a strong shareholder base with over 25% shareholdings from GREs, which helps maintain a strong and sticky relationship with the government-related entities, which also happen to be our shareholders. The pie charts shown on the bottom of the slide shows the total asset segmental split in the first half of 2022, along with the net operating income associated with those same segments. As you can see, it's a well-diversified segmental split of assets and operating income. Our corporate banking accounted for almost 44% of our total assets, retail banking at 26%, our treasury and financial institutions group at 14%, and MIBS, which is Maisra, which is the brand for our Islamic banking window, stood at 16%. The net operating income contribution from these respective segment, again, pretty much corresponds to the asset holding that these segments have, which is corporate banking accounted for almost 47%, retail banking at 32%, treasury and financial institutions group at 6%, and Maisra, which is the Islamic banking window, at 15%. Moving on, slide number 6 shows our progress over the last 32 years. The bank started its operations in the year 1990, and since then, through organic as well as inorganic means, we are now the second largest financial institutions or bank in the Sultanate of Oman. We have successfully, over the last few years, concluded both local and international debt and capital issuances. We have made significant investments in technology and digital transformation, transforming the operations of the bank as well as improving the customer service experience. We launched the Islamic banking window, which is Maisra, in 2013, which is now one of the leading Islamic banking franchise in Oman. We have an extensive footprint, and we operate out of 64 branches for both conventional and Islamic across Oman. Next slide shows some key credit strengths that the bank operates with. As I just mentioned, we are leading second largest franchise in Oman with a very diversified product offering to all our retail, corporate, and Islamic banking customers. We have a strong and stable shareholding to the extent of almost 25% held by various government-related entities. We operate out of a stable and growing operating environment, which is predominantly Oman. We enjoy a solid and robust capitalization, and as I've just mentioned, our capital adequacy ratio stood at 17.15%, as opposed to the 12.25%, which is the minimum that's required by the Central Bank of Oman. We have a diversified and smart distribution channel with an extensive distribution network of ATMs and branches, with 64 branches for both conventional and Islamic, 122 ATMs, 57 CCDMs, which are cash and check deposit machines, 22 fully functional machines as at the end of 30th of June 2022. Looking at the operating environment, Oman being the second largest country in GCC with a population of almost 4.5 million people, enjoys a very resilient and robust economy. Our real GDP growth, which declined during the pandemic years, has since improved to 2% in the year 2021, and is now expected to go up to 5.6% in 2022, as has been projected by the International Monetary Fund. The table on the top right shows the rating agencies which rate our sovereign, which is basically all three: Moody's, S&P, and Fitch, with Moody's assigning Ba3, S&P assigning B+, and Fitch at BB, which was a very recent upgrade that was announced two days ago. Moving on, slide number 10 gives a overview of the Omani banking sector. The Omani banking sector, as we know, comprises of 20 licensed banks, of which 16 are conventional, 2 are state-owned specialized banks, and 2 are fully fledged locally incorporated Islamic banks. The total banking assets as at the end of June 2022 reached OMR 39 billion, of which 6 billion was Islamic and 33 billion was conventional. Islamic banking asset growth continues to outpace the may I request everybody to please be on mute? Thank you. Islamic banking asset growth outpaced the conventional asset growth and grew at a CAGR of almost 6.3%, from 4.4 billion as at the end of 2018 to 6.1 billion as at the end of first half of 2022. Central Bank of Oman, which is the regulatory and supervisory body, supervises all the banks in Oman and ensures all banks comply with global standards which are set by our central bank. Looking at the business overview for BankDhofar, we operate out of three key business segments, which includes the retail bank, wholesale banking group, which also includes corporate bank and treasury and financial institutions group, and the Islamic banking entity, which operates with the branding of Maisra. Retail banking group supports or provides banking services to 290,000 customers across the country with a network of 64 branches and ATMs and CCDMs. We service almost 22,000 corporate customers, which includes large, medium customers as well as SMEs, including the government and government-related entities. Our customer base is well spread across a wide range of industries, which includes trading, manufacturing, services, and contracting. Our treasury and financial institutions group supports our customers as well as the financial institutions and provides various products, including foreign exchange, derivatives, and money markets. Our Islamic bank, which is Maisra, which was launched in 2013, supports the retail, corporate, treasury, and investment banking activities, Sharia-compliant financial services for our customers. The table that you see on the bottom, which I've just briefly mentioned in my previous slide, shows a diversified mix of assets as well as the operating profits that we derive from the various segments that we operate with. Next slide shows the composition of our board as well as the board committees. Our board actively supports and supervises bank's performance through various committees, which includes the board executive committee, the board audit committee, the board risk committee, and the board nomination and remuneration committee. The next slide shows the organization structure of the bank. We have a strong management team with local, regional, and international experience, which is headed by our Chief Executive Officer and Deputy Chief Executive Officer. Our business units and support functions are headed by experienced management chiefs. The bank undertook a strategic transformation plan with a focus on 4 strategic pillars, which is what is getting reflected here in this slide. Customers are core to our strategy. The bank has taken a number of initiatives to improve our product offering and channel support, expanding our reach through digital means, thereby improving customer service and customer engagement. We focus on developing and strengthening our brand. In fact, when you walk into Oman, the first thing you will see at the airport is BankDhofar. So we continue to strengthen our brand presence in the country. We continue to focus on driving a very performance-based culture, providing best-in-class development opportunities to our staff through our performance academy. We do ensure and follow a lean operating model with all the investments that have been done in technology and people over the last couple of years, promoting lean culture as well as improving operating efficiencies. Looking at the financial performance of the bank in the first half of 2022 and previous years, this slide compares the first half of 2022 with 2021, where our interest income increased from 49.9 million to 59 million, an increase of almost 18.4%, which is predominantly on account of improved net interest margins. The net interest margins improved from 2.01% to 2.45% in the last 6 months. Our operating income went up from 63 million to 70 million, which is an increase of almost 11%, an increase of 7.1 million over the last 6 months as compared to the same period last year. Our operating expenses have largely stayed flattish from 33.6 to 34.8, which is an increase of 800,000 as we continue to invest both in technology and our staff. In terms of operating profit, which is net of operating cost, increased by almost 21.4%, which is amongst the highest in the country, in the market, which is an increase of almost 6.3 million to 35.7 million. The bank continues to set aside provisions which stood at 16.3 million as compared to 9.7 million, with the view of improving our coverage ratio, which has since improved from 93% as at the end of year to 97.4% as at the end of first half of 2022. With increased operating profit and increased provision, there was a minor reduction in our net profit by 700,000 and stood at 16.4 million as compared to 17.1 million in the corresponding same period last year. Next slide shows gross loans and advances. As we come out of the pandemic period, we continue to follow a conservative approach to our lending. Our lending grew from 3.489 billion as at the end of June 21 to 3.511 billion as at the end of June 2022. The chart on the bottom left shows the very well diversified industry mix of the industries to whom we have made our lending. Next slide shows the asset quality. The graph on the top of the slide shows both the non-performing loans as well as the gross NPL ratio. The NPL ratio stood at 5.57% as at the end of June 2022, with our absolute NPLs at 195 million. Our non-performing coverage ratio with prudent provisioning policy that the bank has adopted increased to 97.4% and includes both stage 1, 2, and 3 provisions against our funded NPL book. Next slide shows the funding and liquidity. The bank's balance sheet is well funded through a mix of customer deposits, shareholders' funds, as well as bank borrowings. The bank continues to actively manage its liquidity and enjoys strong liquidity ratios, both for regulatory as well as internal monitoring purposes. Bank's CASA, which is current and savings accounts, stood at 43% as at the end of 43% of the total deposits as at the end of June 2022. Next slide shows our profitability over the last 4.5 years, starting 2018. As you can see, as I just mentioned in my previous slides, the total operating income was largely flattish over the last 4 years as the bank came out of the pandemic years, which has now started improving, and in the first half of 2022 stood at 70 million as compared to 63 million for the same period last year, which is an increase of almost 11.2%. Our non-funded income, which is fee and other income, declined from 13.13 million to 11.03 million. However, this was mainly because of a one-off investment income that was there in the first half of 2021. Our core fees have marginally increased since then as we continue to improve our product offerings to our customers, and the bank will continue to focus on improving its fee income in the coming quarters. Our return on equity, which went down to 4.6% as at the end of 2021, has since improved to 6.1% as of the first half of 2022, and our return on asset stood at 0.8%. Our operating expenses and the operating expenses breakdown, as you can see from the slide, stood at 34 million in the first half of 2022, which, as I mentioned, is largely flattish as compared to the first half of 2021. The bank continues to invest both in staff and technology and explore opportunities of cost savings in other areas, thereby managing a robust cost-to-income ratio. Our cost-to-income ratio, which peaked at 57.2%, has since declined to 49.1% as at the end of first half of 2022, and we'll continue to focus on improving cost-to-income ratio in the coming quarters by both improving our top line as well as managing our costs. The next slide shows the details of our yield, cost of funds, as well as net interest margins. As you can see, our net interest margins improved from 2.01% as at the end of 2021 to 2.45% as at the end of first half of 2022, which is an increase of almost 44 basis points. This was mainly because of improvement in asset yields, which went up by 14 basis points to 5.28% in the first half of 2022. Our cost of funds in the same period declined from 3.13% to 2.83%, which is a decline of almost 30 basis points. Our NIM improvement is on account of various initiatives which are taken by our Asset Liability Committee, which is the ALCO committee, and which continues to actively manage the cost of funds for the bank. We continue to focus on sticky and non-price sensitive deposits, thereby improving our cost of funds, which has been achieved over the last 6 months, and we continue to do so. Next slide shows the capital adequacy ratio and the capitalization overview for the bank. The graph on the top of the slide shows the capital adequacy ratio. Over the last 4.5 years, the bank has consistently maintained a capital adequacy ratio of upwards of 17%, as compared to the 12.25, which is the minimum required by the Central Bank of Oman. We have a robust capital adequacy ratio at a total level, as well as the CET1 ratio, which is the core equity. The bank has consistently distributed dividends over the last many years, and our risk-weighted assets have largely stayed flattish over the last 2 years, following a conservative lending approach. So just to conclude my presentation, I would like to leave some key points with the participants. As I mentioned in my presentation, our operating profit increased by 21.4% in the first half of 2022, from 29.4 million to almost 35.7 million in the last 6 months. Our cost-to-income ratio declined and stood at 49.1%, with costs staying flattish, and we have seen increase in our total operating income. The bank continues to focus on increasing its footprint with the expansion of our distribution network of branches and ATMs. The bank continues to focus on improving its asset quality with prudent provision management, as has been reflected in our performance over the last few quarters. The bank is supported and managed by an experienced management team, which is focused on driving performance. So with that, I will pass on the meeting back to Faisal to open the meeting for any Q&As. Faisal.
Now I'll open the floor for the Q&A session. Kindly raise your hand, and I will ask you to switch on the camera and introduce yourself, and followed by your question. So Bishan?
Yeah. Hello.
Hi, Bishan.
Good afternoon.
Can you switch on your camera?
Okay, sure. Yeah. I think it's not working properly. Can you hear me? Gentlemen, can you hear me?
Yes, we can hear you.
Yeah, that's fine. Mr. Mirani, thank you so much for the presentation. Thank you, gentlemen. It was very thorough, very insightful. Thank you so much. I just had a few questions. I'll go one by one if that's fine. you mentioned about cost to income. If you could just give us some flavor on where the target cost to income ratio is, because historically it's been in the high, in the mid 50s, and we've seen it dropping this year because of high operating income. So what is the target cost to income ratio for the bank? If you could just give us your guidance or at least your thoughts on that.
Thank you, Vishen, for your question. Yes, you're right. The cost to income ratio for the bank was, as I said, peaked at almost 57% as at the end of 2021. Cost to income ratio, as you know, is a function of both income and cost. As I said, the bank has invested significantly in technology and transformation initiatives over the last 5 years, which has a flow-through impact on its depreciation. So, obviously, because of which the cost to income ratio historically was upwards of 50%, as you would have seen in our last 3 to 4 years. Now we have started seeing that coming through our performance in terms of increase in operating revenue. So we are hoping that our cost to income ratio should improve going forward. We have already seen a significant improvement from 57% to 49% in the last 6 months. Definitely, we will be looking at opportunities both on the income side, and should that require any investment from a cost perspective, the bank will be open to consider. Having said, given the significant investments that the bank did and the benefits of which are now coming through, we do expect cost to income ratio to improve in the coming quarters. I will not put a target as such, given the nature of this ratio, both from a cost and income perspective. But yeah, we do expect this to improve going forward.
Noted. Thank you.
That helps, Vishen.
The next question. Yeah, it does. It does. And you're right. You had invested heavily in technology, so I take that point. I appreciate that. The next question is, I noticed, which is commendable, the cost of funds have come down in Q2. Now, what I find interesting is going through your notes is that if I look at your deposit base, and it's predominantly time deposits, right? Now, the time deposits have shot up almost by 17% in this quarter, and 6%, on a monthly basis, while your CASA has fallen by 6% in this quarter. So could you reflect on that going forward? Because I see a shift in your CASA from almost a 48% in Q1 to 43% in Q2, which means the shift is more towards an expense side. So if you could just comment on that, and then I'll build up on that a bit later.
Sure. Again, it's a good question, Vishen. Our CASA did marginally decline from 47% to 43%, as you would have seen in the presentation. But in terms of absolute CASA, if you see, between the Q2 of 20, which is the first half of 2021 to first half of 2022, it has marginally increased from 1.626 billion to 1.684 billion. During the same period, because of our total liability base decreasing, you see the total CASA coming to 43%. I mean, obviously, we manage our cost of funds quite actively as part of our ALCO initiatives. And as I mentioned, we are focusing largely on non-price sensitive sticky deposits. So, that has helped the bank improve its cost of funds in the last 6 months. So yes, anything which is price sensitive in nature is not something that the bank is focusing on, and that's allowed us to improve our cost of funds over the last 6 months.
Understood. But the reason I asked this is because we had this price deposit scheme, which the big boys or the big banks had benefited from previously, which ended on 31st December. And across the board, we got the impression that that would have a big impact on the cost of funding for the banks that relied on this deposit scheme. So the question was, in conjunction with that. The next question is, with regards to risk. I mean, everyone talks about it. It's one of the most, highly spoken about topics. Now, if I look at BankDhofar, and we appreciate this, in the past, that the bank was attempting to clean up its books. If you look at cost of risk previously in 19 and 20, it was higher than the sector. And then 21, strange enough, the cost of risk came down. And again, now we've seen a jump in cost of risk higher than, the industry average. Now, I'd just like to comment, restructured loans is something we've been following very actively because the moratorium partially ended on 31st December 2021. Now, if I look at BankDhofar specifically, a number that sort of stands out slightly alarmingly for me is the restructured loans, which stood at 210 million as of 31st December, and it's almost doubled to 414 million as of June. Now, the reason I ask this question is because if I break down your gross NPL, which is at 5.6%, the stage 2 of restructured loans are almost at 7.9%. Now, I appreciate the fact that you've increased your provision coverage ratio from 93 to 97%. My question is this stage 2 number of 7.8%, if some of this were to trickle down into stage 3, wouldn't that obviously mean a much higher provisioning requirement? Or if you could just care to comment on this restructured loan jumping up so significantly, please.
Yes, you're right, Bishan. I think restructured loans, was of course as a central bank allowed banks to defer the loans payment because of the challenges that were being faced by the customer, has seen an increase to 414 million. And I think this is not a problem peculiar to BankDhofar. It is actually an industry-wide issue where we have seen a jump in the restructured loans. And that's also getting reflected in the increase in the overall stage 2 exposure, as well as the stage 2 provision. And again, as I said, this is not very peculiar to BankDhofar, but it's an industry-wide issue that we are dealing with. Of course, from BankDhofar's perspective, we do follow a prudent recognition policy, be it for stage 2, and also we have managed our customers' accounts and managed this as part of the CBO guidelines. This was, by the way, extended from 31st December and now is extended to the third quarter of 2022. So yes, what you are seeing is the increase in the restructured loans is basically an industry-wide phenomenon. Having said, now with the improving underlying economic conditions, higher oil price, etc., and the industry is coming back, we are hoping that there should be a turnaround, and we should see some improvement as far as restructured loans is concerned. And to address any challenges that may fall out of this portfolio or our non-performing book is one of the reasons why we continue to follow a prudent provisioning policy. So our provisioning went up from 9 million to almost 16 million, which is a 68% increase, which is the highest in the industry. So again, we are very prudent when it comes to making provisions to manage this portfolio.
Understood. And my last question and comments is on the ROE and your dividend paying capacity. Please bear with me. Sorry, you have taken slightly long. If I'm not mistaken, this is for my academic understanding, sir. You mentioned the ROEs have improved, and we've seen that. That's good to know. Now, when we look at your net profit, there of course is an element of perpetual bonds, which adds to your capital adequacy ratio, which is one of the most important ratios as per Central Bank of Oman. Now, even though the perpetual interest does not come on the P&L, it is still something that has to be serviced. So would it be prudent to look at adjusted ROE and what is the bank's target adjusted ROE? And the reason I say this is because and I would like your confirmation on this. When it comes to dividend payment, our understanding is that the CBO allows either one of the two, which is 60% of adjusted EPS or 1/3 of share capital. And we witnessed this in the past, where in 2020, the bank had proposed a 6 paisa dividend, which was 60% of the reported EPS of 10 paisa, but then finally reverted back and ended up paying 4 paisa, which was more in line with the adjusted EPS. So if you could just clear these 2 points for me, sir. Thank you so much.
Sure. Yes, you're right. The ROE that I mentioned, which was 6.1%, is the return on equity on the core share capital. If you see the presentation, and we are going to upload this presentation on our website before end of day today, you will notice we have disclosed 2 ROE numbers, which is the return on core equity as well as return on total core equity, which also includes my tier 1 instruments, which the perpetual bonds that you're talking about, which I think is close to almost 4+%. So we do disclose both these numbers and monitor our return to shareholders on both these both bases. As far as the dividend payment, I think your question, if I understood correctly, Bishan, is the dividend payment capacity. Is that?
Yeah, just to summarize, and sorry, I'll just bring it all together, is, I've seen there's a trend of growing income. We've seen sort of, the liability base or the interest expense marginalized, and that's something that with a higher cost base, I feel that's something the bank has done well to manage. Now, the expense ratio as an absolute number is where it is. It moves in line with the income. My question was sort of more about, if I look at the overall provisions, and you mentioned it rightly, the entire sector is going through this restructuring sort of, cycle. So it's not like BankDhofar stand out alone. It's on the higher side, but everyone's going through the same thing. The question basically was, given the profile of the banking sector and BankDhofar in particular, and given its perpetual load of 155 million Riyal perpetual bond, overall we come on to an adjusted EPS number based on which a dividend is paid. So we're just trying to understand how the ROE and the dividend would be going forward for the next couple of years. That was the overall build-up. Yes.
Sure. In terms of maths, you're right, Bishan. The way it works is, we have our net profits, which goes to my retained earnings, and there's a charge associated. I'm getting a bit technical here. There's a charge associated with the perpetual bonds, which is the interest payout, which is reduced from the total earnings, and the net balance is what can be essentially paid out as dividends, of course subject to central bank approval. So the bank does follow that process. So the entire net profits, when it ends up in the equity table, you net it off against the perpetual interest payments for the bonds, and and the regulatory reserves, etc., that have to be set aside, and the remaining is then can be distributed subject to shareholders, board, as well as central bank's approval.
All right. Thank you so much, Mr. Brani. Really appreciate it. Wish you all the best.
Thank you.
Are there any other questions? Yeah. Raja Adil.
Good afternoon, gentlemen. Thank you very much for this presentation. My name is Raja Adil. I'm a research analyst at EFG Hermes. A few of my questions were answered already. However, I would like just to, if I can get a little bit more color on the initiatives taken at the top line level. We have seen a strong asset yield expansion. If you could perhaps shed some color on the drivers here, and also your efforts in terms of fee income, any focus on ancillary fees and commissions, and any color you could give us in terms of top line trajectory going forward. Should we see a significant rebound there?
I will request our Deputy CEO, Mr. Gopakumar, to take this question.
Sure. No, thanks for that question, Rajay. I think, yes, as you have said, on various factors, starting with management of the asset and liability, the cost of funds, onwards, prudent asset growth in both the corporate banking as well as on the retail banking, as well as the Maisara or Islamic banking division. The asset growth, we will look at adding on a prudent basis and managing the cost, including the deposits at low cost. So that would be the strategy on the asset side. On the fee-based income, we are looking at various initiatives, and that's an area which we clearly recognize that the bank can do much better, and that would be our focus. I'm hoping that the efforts should start producing results over the next few quarters on the fee-based income as well. And you have, Mr. Vikesh has highlighted the effect on the cost-to-income ratio. So we are looking at the cost aspects as well very carefully. So the cost-to-income ratio as well would be of greater focus going forward. So we're looking at overall the asset growth on a prudent basis on both retail, corporate, and the Maisara businesses. Fee-based income, the various aspects that we can add on the fee-based income, the products and services, again, under various businesses of corporate banking, wholesale, Mysara, retail, all those businesses as well, and managing the asset quality and the stressed asset management. So all this would be of focus to us, and we are hoping that this would start providing results over the next quarters. Thank you.
Thank you very much for your insight here. And in terms of NIM expansion, I mean, we've had a 45 bips expansion in the first half of this year. Do you think you can maintain such asset yield expansion and as well as a decline in funding costs over the next 18 months? Let's say in 2023, should we see it as a year where we can see room for NIM improvement as well?
Obviously, a very difficult question. I don't think we can provide any real assurance. All I can say is that would be our effort to protect the net interest margins and look at managing the asset growth as well as the cost of funds in as prudent a manner as possible in terms of the growth as well as getting the margins, because that's very, very critical, and we will continue to be really focused on that.
Thank you. Just I had a question on provisioning costs. You have mentioned your precautionary approach here as a major driver of the increase we've seen this year, and an aim to improve the coverage ratio. Should we expect the bank to continue to build up and set aside precautionary provisions going forward? Do you have perhaps a coverage ratio target in sight?
I think we do recognize that the provision coverage of the bank currently is lagging behind its competition, and to that extent, we will do a little bit of catch up to be on par with the competition. And but we will be doing that in a very balanced and prudent manner.
But you don't have any target in sight in terms of coverage ratio, perhaps, but in the next couple of years?
No, I don't want to set a particular target. It depends on so many factors, market conditions, and all that. So what we really want to be doing is to be on par with all the banks and manage it according to the IFRS and the central bank regulations. I don't have a particular target in mind as to this which should be the coverage that we are looking at. But from our point of view, we'll look at increasing it further, just like what has happened this year compared to last year.
Understood. And just my final question on loan growth, if you could give us a bit more color on loan growth dynamics. Speaking to other banks in Oman, there is a theme of repayments from GREs, given that their cash flows have improved on improved oil price and fiscal position in the country in general. We're also hearing, the fact that loan growth on the retail side, be it personal and housing, is quite subdued. The only positive aspect there seems to be some short-term financing needs on the corporate side. Is this the same picture for BankDhofar, or can you give us a bit of color on loan growth dynamics for the bank this year?
I think you summarized it fairly well. I don't think it's very different as compared to what's happening in the market. Yes, a lot of the GREs, because of the current oil price situation, are looking at deleveraging, and which has to that extent affected us as well during the first half of the year. So it all would depend on that macro outlook. If the oil price outlook will drive to some extent the decisions of the GREs in terms of deleverage or maintaining the assets. So from our side, we are looking at opportunities on the retail banking side, where we have not seen much growth. If you see the last few years, it has been fairly flat. We want to correct that situation going forward, as well as on the other opportunities on lending. We will look at it in a very careful, calibrated manner to increase the asset growth.
Thank you very much. That's it for me. I would like to thank you for giving us the opportunity to discuss with you today, and thank you for your time.
Okay, thank you.
We have a question from Abbas. Abbas?
Good afternoon, gentlemen. Thank you very much for the call. I had a couple of questions. Could I just get your comment on the consolidation that's happening in the sector? You saw Oman Arab Bank taking over Ali's Bank. Sohar International Bank is in talks with the, Bank Nizwa as well as HSBC. How does the management and the board of BankDhofar sort of look at these mergers, the potential mergers that are happening in the sector, and how are you? Is that something that's part of your strategy going forward? I know you were in talk with a couple of banks in the past, but nothing materialized. How do you sort of see this movement in the sector, and what's your reaction to it?
Yeah, can I take this question, please? Yeah, thank you very much for the question. Well, I have to switch my hat now from BankDhofar CEO to the chairman of Oman Bank Association. From that point of view, definitely this is a welcome move in the market. I think it is high time that some consolidation is going on in the market. And I hope this the situation will continue going forward. Now, switching to BankDhofar hat, of course, we have started this initiative a few years ago, and BankDhofar is open for any opportunities that will come in terms of consolidation that will add value to our shareholders as well as to the market. So this is welcome moved, and BankDhofar is also keen in the future if this opportunity comes to take it forward.
Okay, I hear you, sir, loud and clear. Thank you. My second question is, my colleague Bishan was, sort of digging into the cost of risk and how it's been a bit elevated, and Mr. Mirani mentioned that that's been a challenge for the entire sector, not just BankDhofar. But when I look at the numbers and when I look at adjusted ROEs, BankDhofar has lagged the other banks in the sector. Like when NBO and Bank Muscat are close to 10%. BankDhofar's ROE, adjusted ROE, is close to 4%. In a market like Oman, in a relatively small economy where X number of large borrowers who most banks sort of deal with, what do you think, if you had to do a post-mortem, why is it that ROEs have trailed the big boys because BankDhofar is the second largest bank at the end of the day? Why do you think ROEs have underperformed in such a massive way compared to the sector leaders? And as the senior management, how do you see addressing this, and where do you see ROEs moving forward in the next 3 to 5 years?
I think clearly it's a good question, Abbas. ROE is a function of my net profits vis-a-vis the total shareholders' equity that I carry. And Mr. Gopakumar, in fact, talked about the catch-up that the bank is doing to make sure that we are in line with the provisioning coverage that has that is there as far as the peers is concerned. So if you look at the first half results, I mean, I don't want to comment on the results of my peers, but there are some provision reduction that we may have seen in some of the results, which obviously adds to the overall P&L, thereby improving the return on equity for that particular period. And for us, as you can see, with an increased provisioning and the prudent provisioning methodology that we have adopted, has obviously reduced the net profit to that extent, and that's getting reflected on the return on equity as well. So as we build our provisions and improve our asset quality, as well as increase our coverage ratio, you would see this coming in line and even getting better in the next quarters as we come out of the pandemic, as well as get a better asset quality from our customers' perspective, and have a decent and a reasonable provisioning coverage as well.
So first, as you
don't want to
mentioned,
yes, sir. Yes, sorry.
So as you mentioned, in terms of the ROE, the reasons as an analyst or a fund manager that you're looking at, all the numbers are there for someone to analyze and then come to the conclusions. But as we said in the presentation, what we are focused on is to make a few things happen: prudent asset growth, manage the net interest margin, increase the fee-based income, manage the cost-to-income ratio, and stressed asset management and the provisions. We are focused on doing these things right, and we are hoping that if you do all these things right, the end result of the ROE that you are referring to, it should get reflected. I think that's what we are focused on.
Okay, I hear you. I hear you. And my last question is, we spoke about the restructured loans that have been a challenge for the sector. Of course, we're coming off pandemic years. Given that, all of you are very, very experienced bankers in the country, how do you see this restructured loan book behave in the next 3 to 5 years? I mean, how do you see, do you see cost of risk coming up further thanks to these restructuring? Because now that the moratorium has expired, or it will soon to expire, only then will the true risk to these companies' cash flows will come out, right? Do you see elevated levels of cost of risk going forward for the entire sector, not particularly BankDhofar? And of course, by virtue of having a slightly larger restructured loan portfolio, does it worry you a little more than, let's say, another banker?
I don't think so. We don't particularly see it that way. Yes, what the restructure has given effect to is the economy is coming out of recession. There are pickup happening in the economy in different sectors, and we hope it will continue to, because the country's fiscal position, the rating, everything is improving. So that will have an onward effect onto the economy as well. And the companies which have availed of the restructure, see, currently compared to last year, there is no interest deferment now. The companies are paying, and they are getting the time to come out of it, and the businesses to pick up, and so it comes back to a level of normalcy. So I don't necessarily think we should expect, just because of the fact that it has restructured, some are all good companies currently going through the business difficulties because of the economy. As the economy improves, they will do well. So I'm not too concerned about that.
Okay. And my last question is, would you consider something, in the sense that dividends are capped? Because Mr. Mirani mentioned, obviously, that the CBO caps dividends according to two policies. One is adjusted earnings. You can pay only 60% or a percentage of capital. Now, we saw Bank Muscat recently do, sort of use their reserves, come up with perpetual bonds, give it to shareholders as another way of giving back money to the shareholders, and at the same time maintaining healthy capital levels. Do you feel BankDhofar, because could do something like this to return some money to shareholders? Would you consider a buyback if you feel like these prices are, attractive from a bank's point of view, or is it too early to speak about any sort of capital optimization for BankDhofar right now?
No, see, you can do what is a different bank's situation, and the balance sheet position is different. And it all depends on the buybacks, for example, are not necessarily possible. And we are interested in giving, increase the profits, which will help increasing the dividend outflow to the shareholders. That's what we are focused on doing.
Okay. Thank you very much. Thank you for your time. All the very best to all of you.
Thank you. Thank you, boss.
Are there any questions? Well, I guess I'll have to pass it on to the CEO for the concluding remarks.
Thank you, Faisal. Thank you, Vikesh, and Gopa also for your interaction with the investors. I would like to thank all the participants with us in this meeting today, which is the first of its kind, and we hope that we'll be seeing you in the future as well with better results and better information in the coming years. Thank you for your participation, active participation in this meeting, and we're looking forward for a good year, inshallah. Thank you very much.
Thank you. Thank you very much.
Thank you, everybody. Thanks for joining us.
Thank you for joining us.